Okay, nice. Welcome to Build Wealth Deal Drop number 4, what I'm calling Up to My Ears, and that will make sense in just a minute. Thanks for taking time out of your day. I'm super excited. I've been working on this for months, and really want to share this with you. So we're gonna get right to it. You might recall that I went and got my undergraduate degree at the University of Kansas in Lawrence, Kansas, and I double majored in English Lit and Religious Studies. And like everyone who studies these two things, I went and became a stockbroker, okay, at one of the largest financial institutions in the world. And one of the things that I did as a key part of my job was really educating on asset allocation, to equity investors, and just what their goals were and how to diversify, their investments and all these in their portfolios. And ultimately, in those early days in my 20s, I read this book that was monumental to me. It was Charles Schwab's Guide to Financial Independence. And, he's a stock market guy. He's a long-term investor, all the rest of it. He's an index fund person. But the big concept that I took away from reading this book, I'll never forget to this day. It's financial independence, right? So the concept is that you're born, right? You're born, and we live our lives, and ultimately we die, right? But the first dollar that we save, okay, in life is actually the last dollar we spend, and then we're ultimately saving money towards where we live until enough cash gets to, our personal wealth that we're able to live off of it, and that, of course, is called financial independence. And financial independence, okay, is that moment of freedom. That moment where we do what we want, we work on things that we want to, we work on projects that we want to. Retirement is sort of like the old concept of this, okay? But this is like the ultimate freedom, right? And so ultimately it's all about how do we leverage our money to get better returns to work for us so that we're not always just actively working for cash, okay? And today, here's what we're gonna cover. We're gonna talk about a bootstrapped banker. We're going to talk about the ultra wealthy, a quiet revolution happening right now, a once-in-a-generation trend, a partnership, and ultimately how to earn like a bank, okay? And so, we might also be talking about an income fund with preferred positions, preferred control, fully collateralized with target annual returns of 10 to 14%. We might be talking about that. First, I do need to, cover a disclaimer. I can't give financial advice. Historical things don't mean future things. Be an adult. Every investment comes with risks, and you might lose money, and all of these types of things. So I need to get that out of the way with any of these situations. So why should you listen to me? Okay, well, listen, I've acquired 8 companies outright. I'm a minority in 24 more. I've done 3 startups. I've had 3 exits. I'm a founder of Acquisition Lab. I'm a private fund manager. I launched the Entrepreneurship through Acquisition program at the Olin School of Business. I've got my MBA. I was licensed by the SEC. I've got every private market certification out there, and I've been featured in all these places and gave the keynote once at MIT, which was amazing because I didn't even apply to get in because there's no way I would have gotten into that school. I also wrote the single best-selling book in the known universe on buying small businesses, and my mom thinks it's great. I, of course, wrote this book after I bought a printing company, after I bought a distribution company, after I bought a manufacturing company, after I bought a powder coating company, after I bought e-com companies, and I actually spent the last many years, okay, acquiring franchisable intellectual property, okay, and we've also been working Acquisition Lab with Chelsea here, and have been helping people buy existing companies. And this is really anchored around, how I originally found success, right? Which was by merging, the entrepreneur and investor approaches to life into an active acquisition entrepreneur framework, okay? But along the way, after I, bought all these companies, at one time, I owned 6 companies, right, in 3 verticals in different geographic regions with all of these different customers. And ultimately, there was, I hit the point of diminishing returns, and I wasn't able to do more. I couldn't access more leverage, more debt in order to buy companies. I was, I didn't have more cash to just be putting in things. I had to build value where I was. And my ability to continue to scale, it turned out, had this little constraint. Me. It was me. I was the constraint, okay? And so ultimately I was like, how do I just duplicate myself, okay, into a blonde-haired female? And, ultimately it was like, well, let's become an investor and, we'll focus on finding entrepreneurs, but at scale, right? And then I started by doing this by putting managers in my own companies, and that still wasn't as scalable as I wanted it to be. And ultimately, it was all about looking more like this. It was, how do I use cash to invest in the private market and still capitalize on that supply-demand imbalance? But maybe instead of doing it in these scrappy little businesses that I'm active in, how do I do it with institutional grade, assets? And therefore, I ended up, doing this since about 2013 with discipline since 2019, and came up with the pizza by the slice strategy, which is just meaning fractional acquisitions. You don't have to buy the whole pizza every time. Sometimes you just want to have dinner, okay? And, I wish I were making this up. Obviously, everybody has read the single best-selling book on personal finance in the world, Rich Dad, Poor Dad. And everyone knows that the goal is to get out of the left side and onto the right side, right? And you want to be a business owner and you want to be an investor, okay? And that's where the true scale happens, all right? So capitalizing on the inefficiencies, okay, the supply-demand imbalances in the private market is the thing that give entrepreneurs those outsized gains, okay, those things that they're working on, right? And, you have to ask yourself, well, where can we find these investments? And the answer, of course, is alternatives, alternative investments, okay? These are the things that capture the supply-demand imbalance when used the right way. And what are these? It's private real estate, private equity, and private credit, okay? I've shared this before. This is from Tiger 21. This is the portfolio for ultra high net worth individuals, okay? And what you'll see is that 54%, by the way, down 1% since last quarter, of all of their assets are invested in private real estate. And these aren't like REITs, guys, right? This is private real estate and private equity, okay? And so they've got over half of their assets invested in the private capital markets and a little under a quarter down in public equities, meaning stock market. And of course, where are we? We, as the sort of like, everyday millionaire, right? Everyday accredited investor is sort of down here, 100% in public equities, okay? Okay. And so, what we're seeing is a huge surge of demand in private equity as the markets open up. It's not just ultra high net worth people anymore that have access to these things because of the Jobs Act, because I can share deals that I'm working on with our community and we can build awesome things together, which is super cool, right? So as I start to look at these different assets, I look at private equity is really good for appreciation, okay? Real estate is good for appreciation, some cash flow, tax advantages, and credit funds are these sort of like collateralized income, right? And so together, I've been working on building a sort of pizza portfolio of all of these different types of investments. Now, if you follow my work, you know that when I buy small companies, I'm putting down maybe $100,000, $300,000 into a company that's like one of the largest 4% of companies in the country, right? And so when I'm making these investments, I'm putting that kind of sizable investment in each and every one of these so that like I can get the bump from, the institutional grade investments that I'm making, all right? When we look at buying companies, working in real estate, all the rest of it, we're always using some form of the capital stack, all right? And at the bottom, you've got the senior secured lender, right? And then you start to get into these secondary lenders of mezzanine, and then you've got preferred equity, which is usually the equity investment in there, and then you've got common stock, okay? The risk increases as you go up. Your access to the upside increases as you go up. And the senior secured lender, that's sort of like the mortgage broker on your house. Like that person, you're going to pay them every single month forever. But as you improve the house and your market goes up, you're the equity holder of your house. And so you get the upside of that once you pay all the loan off, right? And so as a result, where you are in the capital stack is sort of this maximum income to maximum appreciation kind of analogy, right? And so as I started to think about the investments I was making in the private markets, I use it over to this model. The credit funds are basically big income. Then you've got private equity at the top, which is a big appreciation. And real estate kind of has a lot of, customization in the middle in terms of how you're going to play what it is you're investing in. I ultimately start to think about this and say, like, well, Walker, how does buying existing companies work in this diversification in the private capital markets plan? And to me, it's pretty easy. Buying companies, acquisition entrepreneurship is the foundation of everything that we're doing, right? This is your active income. This is the thing that you're working on. And once you are bringing in, earnings from your own company, or, if you've got a high paying job or whatever, and you just want to diversify into the private capital markets, either way, this is your active solution and this is your passive solution. So I use income from my businesses to invest in different private market assets to diversify my private market holdings. Otherwise, I'm fully concentrated just on my business, okay? I call it the wealth stack, all right? So when we look at the wealth stack and we look at the sort of deals that I've shared over the last 11 months, okay, here's how I want to kind of line these up for you. First, obviously we started Acquisition Lab, 5-6 years ago. And we've had a wonderful success. We've got 875 members. Our members have closed over 400 million in transactions. And guys, these are like, $2 to $3 million average transactions. 35% of our members have acquired a business. Here's Lucas. He's just now closing on his 4th company. This is the kind of person you would invest in. Look how happy this guy is. This was his 2nd or 3rd company, moving all the equipment into his facility. So that's Acquisition Lab, okay? Then I started introducing a couple of deals from, my A real estate team here in St. Louis, AHM. And to date, we've got, we're building the largest mass timber building in the world right here in St. Louis. We've bought a portfolio of value add companies, and these are all in the same neighborhood, guys. We are revitalizing a whole neighborhood and being very strategic about what we're doing. For the portfolio, we're already at a 49% internal rate of return over 11 months. Okay, that's wonderful. We've got 23% cash return to investors in 12 months still planned for the 314, the largest mass timber building. Okay, so really, really cool, iconic, exciting projects that are also profitable. OK Stone is the private equity side. And so we just closed, we're building a manufacturing facility in Dallas. This is me and Oren Klaff looking at a product. And, basically we closed this deal, I think end of October. We as a community acquired a little over 6% of a company worth over $100 million. Our investment is already up over 60% on paper. Okay, and we should be one of the largest 1% of companies in the United States by Q2 of this year. Okay, cool, right? So this is how the investments that I've brought you are sort of lining up with the wealth stack, all right, that we're sort of engineering. And I know what you're thinking. You're thinking, Walker, where's this? Where's this piece right here? Well, I want to tell you a story. It starts in San Francisco, but not San Francisco today, San Francisco 1904, okay? This is a guy named A.P. Giannini. And Giannini was a Italian immigrant, or son of Italian immigrants from San Jose, lived in San Francisco, and ultimately he got a job working at a savings and loan. And when banks started, okay, banks serviced people who had money. Let me say it differently. Banks' customers were rich people, okay? But Giannini wasn't rich. He was an Italian immigrant. And what he wanted to do was give loans to other Italian immigrants, okay? These are not rich people. This is not the target market of the bank. And, Giannini wanted to give loans based on character and not necessarily by how much wealth they had. So he started the Bank of Italy, okay, in North Beach, San Francisco, all right, in 1904. Almost 24 months later, things were going really well. Almost 24 months later, there was an apocalyptic earthquake and fire combination, okay, that absolutely destroyed the entire city, all right? Look at this. This is downtown San Francisco, 1906. Giannini had all of the customer deposits at the bank, And what he thought to himself was, I need to get all the money out so it doesn't catch on fire. Duh. So he went and got all of the money, okay, and stuck it in a garbage carriage and smuggled it to his house in San Mateo, California. Okay, this is his house today. And if you look really closely, you'll also see that they still have, debatably, the carriage in which he smuggled all of the money from his entire bank to his house, okay, during the fires. What happened, though, was super interesting. All the other banks didn't do that. And they couldn't open their vaults because everything was on fire and it was so hot outside for 3 weeks. Giannini had a monopoly on the entire banking system. And so he took 2 barrels and a plank of wood and went out on the wharf, and he was doing extending loans on handshake deals to people who wanted to rebuild the city, to people that otherwise couldn't get them, okay? And he likes to reflect later and say 100% of those loans were paid off. Giannini's work ethic is somewhat legendary. He was riding in his carriage, and he noticed behind him another competitor probably going to the same place. So he took a shortcut, and he abandoned his horse-drawn carriage. He swam across a pond, he ran to the client's house, and he closed the deal with signature just as the other lender was showing up. As the ability for banks to own multiple locations became legal, okay, in 1909, Giannini noticed that a lot of his clients were coming from San Jose. He opened the first branch to his bank in 1909. He may have been the first banker to have multiple branches, okay? I'm proud to say that this guy's brilliance didn't end there. He actually pulled a full-on buy then build strategy and acquired hundreds of branches across California. And in 1923, in Los Angeles, he acquired this little bank called Bank of America. And Bank of America had the name that Giannini matched with his bigger vision of what it was that he was doing. And so he adopted the name Bank of America across all of his branches. From there, he continued to give loans that couldn't get loans otherwise from other bankers, okay? Let me give you some examples. Henry Kaiser wanted to build warships during World War II. Giannini gave him the money. Hewlett and Packard had a crazy startup idea. He gave them the money. A guy named Walt Disney, who had never made a movie before, got financing for Snow White from Giannini. Giannini gave Charlie Chaplin's film the money to get started. This guy financed the whole origination of the Hollywood film industry, as well as the entire California wine industry. During the Great Depression, pun intended, Giannini gave a bridge loan to construct the Golden Gate Bridge. It shouldn't be surprising that by the mid-40s, Giannini had built one of the single largest bank in the United States, in Bank of America, okay? All because this man, okay, had a vision to give loans to people that couldn't get them from regulated banks, okay? Now, if Giannini was alive today, Walter Isaacson would write a book on him, and on the cover, he would probably look more, like this. But more importantly, Giannini would be very aware of something that's happening right now, the quiet revolution, okay? The global financial system is undergoing transformation that is reshaping access to capital and creating unprecedented opportunities for investors right now, okay? So here's what I've got for you. What we have on this graph is the restriction, okay, of capital, of lending, okay? And so what we've got here is over time. And so I'm gonna go ahead and draw this line, okay? JT, we okay? We got cameras? All right, good. I'm gonna draw this line. We have everything above this line is the tightest credit, okay? The tightest credit. This is today. The recent times, okay, that banks have been this tight were COVID-19, the Great Recession, and the recession of the 1990s. Is there a recession going on right now? Maybe we could debate that. I'm going to say no. We don't see any economic indicators that there's a recession happening. Okay. Instead, here's what's happening behind the scenes. It's called bank retrenchment. Okay. In the aftermath of 2008. Okay. Remember the too big to fail. All right. Ultimately, everyone bailed out the banks and then said, okay, look, boys, you can't just run around like cowboys doing whatever you want. All right. We're going to increase regulations. All right, we've got Basel III, we've got the Dodd-Frank. And so as a result, we're going to force you to increase your capital reserve requirements. We're going to restrict these risky loans, of things that aren't necessarily collateralized. And we're going to limit leverage, okay, that banks can have. Right after this, okay, did you know this? Banks have declined by 28%, okay, since what, 2013. In the last 10 years, almost a third of all banks are gone. Okay, as we predict, there's new Basel III regulations coming down the pipeline. What's going to happen? We've got increased capital requirements. We've got changes in business model. We've got increased liquidity requirements. We've got compliance costs, and the impact on small banks is going to be detrimental. We are expecting further consolidation in the number of banks because small banks aren't going to be able to lift the expense. Okay, we'll see what happens. At the same time, all right, we've got these bridge loans that originated in 2021 and 2022 in the oversupply areas that are taking up all of the loan to deposit ratio of the lenders, and so the banks aren't able to cycle through the money because these things are just kind of getting long in the tooth, right? We've got this lack of payoffs as this oversupply in the certain markets haven't been able to get on board with additional renters coming in to fill the cash flow requirements. And we've got, these are the cash flow covenants. This is the oversupply not getting full yet. And then we've got, traditional lenders are just pulling back on the leverage ratios on top of all of this. So in the lab, we talk about the loan to deposit ratio that banks operate on. Okay. And once you start stressing that, credit is going to tighten. Guys, these banks are getting squeezed. They're getting squeezed, right? And so as a result, they're pulling back. All right. They're reducing their exposure to riskier loans. They're slashing lending to small and mid-sized businesses. They're focusing instead on safer, larger, and more profitable corporate clients. They're pulling out of non-core markets, okay, and they're leaving a significant portion of small and mid-sized borrowers underserved by traditional loans, all right? This is creating a massive gap in the lending market to the tune of $4.8 trillion in demand from all small to mid-sized businesses, investors, real estate that's being unmet globally right now. Okay? Private credit, all right, is able to create it has a unique advantage in this whole structural realignment because borrowers are going unserved and they're looking for alternative solutions to being able to finance their deals. Private credit has confidence and speed to closing, as well as being able to provide a bespoke, customized solution to the actual deal and the thing that can make sense. And there's, because it's unregulated, okay? Because it's unregulated. What is private credit, okay? It's essentially anything that is non-banks, okay? I have a friend named Jason. I'll say it like that because he doesn't know I'm going to talk about him. He makes $1 million a year just making hard money loans to people that can't get mortgages from banks, okay? And he personally interviews them, looks at the asset, whatever, makes the loan. To my knowledge, no one's ever missed a payment. They've all been good loans. It's people that, need an opportunity, just like Giannini, okay? And so, by the way, not all credit funds, it's almost becoming a buzzword. Like if you didn't know what a credit fund was, a week ago, but then you found out a week ago, you might be introduced to this in slightly different ways. There's uncollateralized, okay? There is under-collateralized. There's, business versus real estate. There's all these types of things. Some syndicators are actually creating credit funds in order to finance their own, real estate deals. That's not what we're doing here, okay? These are, in my opinion, over-collateralized kind of good position. We'll talk about this in a minute. So ultimately, we as investors, okay, we're looking at, risk and return, okay? And the thing that, if we look at all the different investment opportunities that we have out there, right? And we just ran a regression, it would kind of look like this, right? You've either got, high risk, high return, or low risk, low return, right? That's what happens. And so ultimately, we're all trying to figure out how do we get up and to the left? how do we find this, lower risk, higher return type of investment? And, of course, that is, the very special thing in the supply-demand imbalances, and if you can find them. And so ultimately, BlackRock came out and said, hey, we have looked at all of the risk-adjusted returns of all of these different asset classes. And for the next 5 years, we are estimating that private credit is number one. Number one. By the way, if you care, the other things right under here are all the other things we're talking about. Okay, here's US real estate, here's private equity. So, all of these, private capital markets are all towards the top. Private debt is all the way at the top. Okay, why? Going back to the capital stack. So, this side. So what you have in the capital stack is you've got your senior secured lender, okay? And we're able to go in second position, okay? And we have to get paid off in full before the sponsor on that asset can get any money out, okay? So we're not necessarily the senior lender, but we're able to slip in and fill this little need on certain assets, okay? So we've got priority of payment before the entrepreneur, before the sponsor. We've got current cash flow that's coming in. We're lower in the capital stack, which is reducing risk. And we also generally have, takeover abilities where if the sponsor or entrepreneur isn't performing, we can go in and actually take over the whole entire asset. And as long as you're equipped to operate it, okay, that's actually a great outcome. Not for them, but for us. It's new upside. So what do these deals look like, Walker? How does this make sense? On new deals, okay, look, if the senior lender falls through, we can come up with cash, quickly in order to, bridge something, or, if the equity doesn't come in, we can bridge that gap. We've got loan assumptions. So a lot of people are buying assets that have really low interest rate loans, and they want to assume those loans. But, that might only be, say, 45% loan to value, and they want to get to 65% loan to value in order to, still have a comfortable equity portion, but increase returns to their investors. That 20% gap is perfect for, what it is that we're doing. Then we've got new construction. So things like bridge loans and really healthy markets. Here in the Midwest, we're still getting 6% rent increases. Okay, there's no oversupply going on here. Okay, real estate, as you know, is a very local thing. And so new construction with very low LTVs is risky according to these regulations because there's no asset left. Okay, so you've got to be able to look at these things and have them make sense in order to do it. Then there's on existing deals, you might have a distressed situation. We are not doing distressed loans in this fund that we're going to talk about. And it could just be capital injection. Maybe someone's not prepared to refinance yet. They don't want to refinance yet because they've got this great low interest loan, or, maybe because of requirements, they need to increase their capital, whatever it is. So these are all of the types of things, that we're looking to do. And so private credit is uniquely positioned to deliver all of these things. And on the investor side, you're talking consistent payments and attractive risk-adjusted returns. So Walker, where's the money coming from? Right. So rich people, okay? We've got family offices, we've got hedge funds, and we've got registered investment advisors. This is where all of the money is coming from, or the lion's share of the money. Family offices are rich people basically running their own private equity company internally. Hedge funds are people that manage rich people's money, and RIAs are people that sell assets to other rich people, okay? And all of these have, between 9 and 11% allocation to these private credit funds. The chart I showed you before, their fixed income was hiding right here the whole time at 8%, okay? So this is fixed income for rich. This is how the rich do fixed. And if you go back to asset allocation, and it doesn't matter if you're conservative all the way up to growth minded, there's always some sort of allocation, in a perfect engineered portfolio towards fixed income, okay? Towards fixed income. By the way, if we went back to the risk adjusted chart for a minute, you would see that bonds were actually way low. I'll let you think about that. So anyway, it's fixed income, but it also matches the types of returns today that we see historically in the stock market in equities, but without the volatility. So that's interesting. And I can't give financial advice. We've covered that. But as someone that pays a lot of attention to this, I'm also noticing that, the CEO of JP Morgan just came out and said, yo, stock market's overvalued. A guy that I read every single week said, hey, current valuations are at 21.7, and the 5-year average is 19.5. So he's expecting a pullback in the market. If you haven't, reallocated anytime recently, maybe it's a good time. Maybe it's a good time. I'll let you decide. I don't know your situation. But we are looking at a growth in this private credit space to like Olympic proportions. So check it out. Over the last 10 years, 2013 to 2023, okay, you've got like this went from, $436 billion, okay, and it increased 293% to $1.3 trillion, okay? Morgan Stanley is expecting this to increase by 64.7% in the next 3 years to 2.8 trillion, which, by the way, is over 100% growth every single year. Why? Because it's so attractive to many people that actually are in this space. I'm not making this up. Okay, so it's a seismic change that's happening right now. Bank retrenchment is a permanent structural realignment that's happening. As banks continue to pull back, private credit will be able to step in. This is I believe, this is right now the private credit moment. Okay, and so it's a great time to talk about it. So let's recap. Higher yields, consistent income, portfolio diversification, downside protection, risk-adjusted returns, okay? All of these things. Walker, I'm sold. Let's go start a private credit fund and do some of these loans. Great. Let's just talk about some of the challenges that we're gonna have. First, we have to get access to deals. We need deal flow, okay? We need deal flow of all of these sponsors, which, I don't have. Do you have that? Okay, and then if we get that, then we have to underwrite them. I don't know how to do that. Do you know how to underwrite these deals? Okay, and then we have to negotiate investor-friendly terms, okay? And then we need to service the borrowers and make sure that they're paying on time and doing all their metrics. And then we've got to, source all the cash if we're actually doing this at scale, because ultimately we have to build a diversified portfolio and manage that whole thing, as well as monitor it and do the compliance and do the reporting and all of these things. And oh my God, that's a whole business. There's so much to do. So I was motivated. I went to a couple of sponsors, multifamily guys, and said, listen, would you have room for, if I raised a bunch of money from our community and we came in and we're just looking for just fixed income pieces, could we come in as preferred and maybe take out all your other investors and be that piece? I got a yes and a yes. I was like, okay, this is kind of interesting. But then it started to dawn on me that I have to do all this stuff, right? It's like you have to build this whole actual portfolio. And after I sold my primary residence and bought a new one, by the way, that was about 70% more in price, I took all the money from the house and put it in a portfolio of credit funds, made all the mistakes, put it in ones that I shouldn't have and all the rest of it. And the one that I invested in that was doing the best was from Aspen and Aspen Funds. And so, this is a small check. This is a very small check that I got from them, but it was last week. Okay, so I'm just showing you, this was from my bank account. But it's one of these where Aspen Funds, okay, I've personally invested with them about two or three different funds, okay? They've got 250 million of investor capital. They've got 600 million assets under management. They've been doing open-ended debt funds for over a decade, and they've done $65 million, okay, in investor distributions. They also have 4 active funds with 3,500 assets that they've purchased. Okay, they've got all of these different assets in their portfolio. So if you needed to take over an asset because you had a bad loan or something, these are the operators. They've got non-real estate experience and industrial. So they're managing a lot of assets and they're running open-ended funds already. They're only 4 hours from my house, so I went to go visit them. Okay, this is Bob and this is Ben, father and son. Just kidding. Anyway, so the point is I went to go visit them, and I was like, hey, I've got this community. We're building the wealth stack. I want to talk to you guys. And when I met Bob specifically, he's like, Walker, I love debt. I'm up to my ears in debt. I love it. Okay. And so as a result of this trip, I am pleased to introduce BuildFlow I Private Credit Fund in partnership with Aspen Funds. Okay. And so okay, what are we doing? So ultimately, we're focused on providing current cash yield as well as upside profit share while investing in preferred positions, okay, in these assets. So we're going to build a diversified portfolio in different locations with different sponsors and different assets and all the rest of it. We currently have 7 assets in the fund. And it's an open-ended fund, which has a lot of very interesting structures. Let's talk about what we've accomplished so far. We've reviewed and underwritten over 100 million in deals. We've closed on 7. We currently have 7 in the portfolio. The gross yield is 17%. Okay, we've placed $15 million already of investor capital, and we've got another 15 million ready for commitments right now. And we started mid last year, this fund, and it's at 10.46% annualized yield to the investors, okay? I didn't just go in and be like, I like these guys, let's do it. I brought in a former vice president from Goldman Sachs, and we re-underwrote all of the assets from scratch as if we knew nothing about it, okay? And I'm pleased to tell you that it was just flying colors all the way through. So let's talk about this fund. We've got regular distributions, okay? Preferred return comes out monthly, okay? After a 3-month hold period to place the capital that's come in. Then you've got the profit share. The profits from the quarters is paid out quarterly after a 3-month hold period. And then you've got an option to actually automatically reinvest. So if you don't want to live off of the cash flow coming in, you can compound your investments and actually get a higher rate of return internally, okay? It's an open-ended fund with a quarterly net asset value reported. So what that means is it's non-dilutive. So as we grow the fund and more money comes in, we're able to add more assets and more diversification to continue to grow the net asset value of the fund itself, okay? The fund is going to invest in preferred equity and mezzanine loan and commercial real estate. We want commercial real estate, 1, because it has collateral, and 2, because in an event of a default, we can operate it, okay? We've got the people to do that. There's 30 people at Aspen Funds right now. What time is it? Are they still at the office? And so the focus of our fund is going to be generating current cash plus profits at a preferred position in the capital stack, all right? Investor protection is non-dilutive. There's also a high watermark. So if we're not hitting that preferred return, the GPs don't make their GP portion, okay? Then we've got the preferred distributions, account statements and fund reporting produced quarterly. We're also, Aspen is building a institutional grade fund right out of the gate. We're going through the first audit right now, the third-party audit right from the get-go so that investors can have confidence in what it is that we're doing. Investors, there's also this awesome liquidity piece. So a lot of credit funds, they're just completely illiquid. It's like, hey, we're going to send you checks, but you can't have your principal back for a decade. Okay, we've got liquidity in here. There is a 2-year hold period, okay, and it is best efforts. It's best efforts, but after the lockup with 90 days notice, as long as it's not a huge amount of money, we can pay it out. I can also tell you, Aspen Funds to date has been able to satisfy every single request for partial or full redemption across all 4 of their funds, and they've never missed a monthly payment, dividend to an investor, ever. Structure. Minimum investment in this fund is $50,000. There's an asset under management fee of 1%, but all of the returns I'm going to show you in a minute are after fees. Accredited investors only, low leverage. So we've got a approved line of credit that we can also add in to grow a little faster and let money catch up, which should enable us to spike returns a little bit more. Okay, so reasons to invest. High current yield, preferred position in the capital stack, open-ended structure, okay? And in addition, we've got the strong sponsor team that's been doing this for a long period of time and can take over the assets when needed. We've got alignment and co-investment. Myself and every single member of the Aspen management team has invested their own money into this fund, and it's a diversified portfolio with all these different assets and sponsors, okay? So we've got sophisticated underwriting, target investment size and speed, targeting $1 to $5 million. So these are the smaller loans that a lot of these bigger private credit funds won't actually go after. This is my space, right? Like the $1 to $5 million acquisition, this is exactly where the market that we're serving, okay? We've got experienced operators, and we actually have an increased return. Here's what I'm gonna tell you, Aspen Funds is out there. Like, you could have found them yourself and just invested in their fund, right? But the thing is if you come in through the BuildFlow, through our community, I've actually negotiated a better deal with them where more of the money is going through to you as the investors in our community at BuildFlow, which is super exciting. So you've got a spiked return. Now, this is the target return overview. Minimum investment is $50,000. Investors get a 6% preferred return. And then there's a 90-10 split, okay? That's just one example. Had you invested in Aspen directly, it's like a 70-30, okay? So that's one example of where we've gone. So the target net total return annually is gonna be 10 to 12%. Net cash yield is 8 to 11%, and compounded, if you choose to compound, is 11 to 14, AUM fee 1%. The thing with these though, is that like, because this is from, their PPM. And so like, based on my model, if we do, there should be about, 50 basis points that are carried through in addition to what's here if you come in through the BuildFlow.